Whenever volatility picks up in the stock market, investors tend to get a little nervous and oftentimes are tempted to stray from their long-term plans and do one of the following. First of all, they're tempted to shift to a more conservative portfolio after a few rough days in the market, or they're tempted to try to time the market by getting out altogether and then jumping back in. But both strategies are hard to pull off and can be detrimental to the long-term success of your portfolio. Now, over the past 17 years, the price of electricity, food, and medical care all rose at or above 3% per year. And over the same time period, the life expectancy of the average American has increased by 2 years. So don't be so concerned about market risk that you become more conservative and overlook longevity risk and inflation. Now, secondly, trying to time the market is extremely difficult to do. Abandoning your investments based upon fear often means only getting back in after you've seen a nice upswing, which means that you've now missed out on those positive market days. This chart shows that why it's imprudent to remain invested for the long term and accept market volatility as a normal part of investing. Simply put, an investor who stayed fully invested in the S&P 500 from 1998 through 2017 had an average return of 7.2% a year despite 2 major market downturns. Had you tried to time the market and missed the best 20 days in the market during that period, your average return for that 20 years would have been 1.15%. So yes, stock market investing can be crazy sometimes. So know your risk tolerance, and most importantly, have a plan. Having a personalized financial plan will help guide your decision making during turbulent times.